how interwoven climate factors are with price stability. Beyond weather-driven market volatility, government regulations have become a major catalyst in reshaping energy markets. International accords like the Paris Agreement aim to limit global warming by enforcing stricter environmental policies. For many nations, this includes carbon pricing and emissions limits, which are making traditional fossil fuels such as coal and oil less appealing. Investors are seeing growing divestment trends, where large funds and institutions actively shift their portfolios away from fossil fuels and into greener alternatives. This movement, though grounded in sustainability, has a clear financial motive. Markets are rewarding companies that align with environmental regulations and penalizing those stuck in old, polluting ways. For example, carbon taxes increase operational costs for coal and gas producers, cutting into profit margins. Meanwhile, cleaner technologies, such as solar, wind, and even hydrogen, are becoming more cost-competitive. Regulatory pressure is accelerating this shift, and those who adapt early will benefit from the growing pool of sustainable capital. If one thing is becoming clear, it's this. Renewables are no longer a niche. They're a powerhouse of growth. A report by the International Energy Agency predicts renewables will account for almost 90% of global energy capacity expansion in the coming years. That's good news for investors looking to ride the green wave. Solar and wind technologies lead the charge, as plummeting production costs make them highly competitive against fossil fuels. But it's not just about generating power. The rise in battery storage technologies and advanced grid systems is eliminating the intermittency problem that once held renewables back. Even traditional energy companies are not sitting idly by. Major oil corporations are investing heavily in assets like offshore wind farms as part of their pivot strategies. This dual model, balancing legacy fossil fuel operations with renewable investments, offers stability for these companies and their shareholders during the transition period. For investors, this growth trajectory means opportunity. Sectors such as renewable infrastructure, electric vehicle, EV charging networks, and utility-scale battery systems are emerging as high-potential areas for growth. While renewables are climbing, fossil fuels remain an important yet unstable part of the equation. Oil, coal, and natural gas haven't disappeared overnight, but their dominance is weakening under the pressure of regulatory action, divestment campaigns, and diminishing public trust. Price instability is a hallmark of today's fossil fuel markets. Shortages or surpluses caused by climate-related disruptions, such as droughts affecting cooling water for coal plants or geopolitical issues restricting oil supplies, send prices spiraling unpredictably. Even natural gas, once touted as the bridge fuel in the energy transition due to its lower emissions compared to coal, is facing challenges. With innovations making renewables more efficient and storage solutions more viable, gas is seeing its role diminish. For investors still tied to fossil fuels, the key is agility. While they may offer short-term profits, long-term risks like stranded assets and irreversible sector shifts are growing concerns. For those navigating this complex terrain, there's one comforting truth. Disruption breeds opportunity. The energy transition, driven by climate change, is creating entirely new industries and reshaping existing ones. Innovative companies embracing green technologies, think solar panel manufacturers, wind turbine developers, or hydrogen energy startups, are paving new paths for investors. Many of these companies are early in their growth stages, presenting significant upside potential. Meanwhile, established players in traditional energy markets who are pivoting towards sustainability can provide a more stable, predictable form of growth. Diversifying your portfolio to include companies navigating this transition successfully is a wise strategy. Emerging markets also deserve a closer look. Countries in Asia and Africa are leading the renewable energy adoption curve, with growing populations and energy needs steering investment into scalable, green solutions. Being part of this expansion offers accessible entry points for portfolio diversification. Navigating energy investments in times of transition requires a keen balance between risk and reward. Here are some key strategies to consider. Diversify energy investments. Avoid putting all your resources into one type of energy. A mix of traditional and renewable investments offers a hedge against volatility. Embrace ESG criteria, environmental, social, and governance. ESG factors are becoming a priority for both regulators and investors. Companies with strong ESG records tend to perform well in terms of stability and long-term growth. Think long-term. While fossil fuels may offer short-term returns, the energy transition is inevitable. Prioritize investments that align with where the energy market is heading, not where it has been. Stay informed, track global regulations, technological advancements, and market trends closely. Knowledge is your most valuable asset in this rapidly evolving field. There's no better way to understand the energy transition than by looking at real-world examples. Consider oil giants like Shell and BP, which have invested billions in offshore wind projects. These efforts to diversify energy offerings while maintaining their core products have stabilized their stock prices, even as other oil-focused companies witness volatility. On the renewable side, companies like Tesla are leading the charge in reshaping energy storage and electric vehicles. Similarly, Orsted, a company once rooted in fossil fuels, is now a global leader in offshore wind. Its transformation has not only boosted its market value, but also set a benchmark for other traditional energy companies. Large institutional investors are also shifting course. BlackRock, the world's largest asset manager, recently announced plans to make sustainability its standard for investments. Moves like these are indicative of broader trends redefining the financial landscape. Of course, no investment strategy comes without challenges. The energy industry is notorious for its susceptibility to greenwashing, companies marketing themselves as sustainable without substantive evidence of change. Investors must double down on due diligence to verify whether a company's green initiatives are genuine. Overvaluation of renewable stocks is another potential pitfall. As climate tech becomes more attractive, some companies may see inflated stock prices, making it crucial for investors to study market fundamentals carefully before entering. Finally, the pace of energy transitions varies across regions. While developed markets are adopting renewables rapidly, emerging markets may face hurdles due to infrastructure gaps or political challenges. Understanding these regional differences is vital when planning investments. The future of energy commodities will be defined by the interplay of climate policies, technological innovation, and market adaptability. As renewable energy technologies continue to grow, traditional energy commodities will face challenges that can no longer be ignored. For investors, this means two things: urgency and opportunity. By staying informed about evolving regulations, monitoring market-leading companies, and diversifying portfolios with an eye on sustainability, you can make smarter investment decisions today to thrive tomorrow. This isn't just about navigating risks, it's about seizing the incredible opportunities born out of our changing world. With strategic thinking and a willingness to adapt, the energy transition could be one of the most rewarding investment themes of our era. Thank you for tuning in, and don't forget to subscribe and share this video to encourage conversations about this critical topic. Let's invest not only for profit, but also for a sustainable future.